Hello everyone and welcome back to the sessions on financial management. Friends, in this class of financial management, we are continuing with a very important topic, that is capital budgeting, and we are into the second part of capital budgeting. Now in this second part of capital budgeting, we are going to start our discussion about this topic, that is sensitivity analysis. Let me remind you, second part of capital budgeting is all about risk analysis under capital budgeting. And the risk analysis techniques we have classified into two categories. One was the traditional technique, one is the modern technique. Under traditional techniques, we have found three different approaches: RADR technique, that is risk adjusted discounting rate technique, certainty equivalent technique, and the third one, it is sensitivity analysis. And of course, sensitivity analysis also includes another segment, or I would say extension of this concept, in the form of scenario analysis. But first we will be learning sensitivity analysis. We will then learn what is scenario analysis, how does sensitivity analysis differ from scenario analysis. We will talk about those things in detail. But let us first understand sensitivity analysis. Now I should tell you something about human psychology. When you are dealing with a topic like this, it is definitely a capital budgeting concept, but there is a psychological impact over here. Please try to understand what I am trying to convey to you. This world is filled with people who don't want others to progress. You know, we always say that have a positive mindset, have a positive attitude, but many people across the world, you will find that these are leg pullers. They don't have a positive attitude. They will always try to talk negative. They will always try to demotivate people. They would want to, not participate in someone's success, but rather they would not want someone to succeed. And they would show that they are worrying about those people, but actually they are not worried about anyone. They just have one agenda in life: to pull other person's leg, not to let other person progress. So what happens? Suppose you are trying to do something good and you come and tell me that, sir, I have planned something like this. Imagine what will happen. I said, wow, this is a great idea that you have thought. I'm sure you would have made all the proper analysis, and if you need any kind of help, if I can be of any use, do let me know. You have a fantastic idea, definitely go ahead with that. Before you do that, definitely look into all the risks and all the possible adversities, and I'm sure you would have analyzed. Wish you all the best. This is one way to put this point. Another way is, the moment you convey that, sir, I have this idea, I tell you, no, see, this is a bad scenario right now, what is going on. Lockdowns everywhere across the world, stock markets are not giving good returns, there are losses and losses everywhere. In such a crisis filled situation, in a lockdown kind of situation, in a pandemic situation like this, when you are starting something new, it could be dangerous, it could be filled with risk, but still it's your business, your call, you only decide. Now tell me, in both cases I had nothing to do with your business, right? I had nothing to do with your business. In the first case, what I am giving is a positive motivation to the counterparty. In the second case, I am throwing a doubt on someone's mind. See, your objective in this universe is not to throw doubts. You should be here to get your doubts clarified. Correct? Don't put doubts in other people's mind. If you want to put something in other people's mind, try to spread clarity. Don't try to spread doubts, right? So as I told you, this is all about human psychology. People do like this, and you can't help. The world is filled with people like this. You have to make your own way. So today, if I tell you about myself, these negative thinkers, these negative influencers, I have made myself completely immune from these people. And the secret is sensitivity analysis. Now, are you willing to know how can sensitivity analysis help you in making yourself immune to these negative kind of surroundings? I'll tell you. There's one popular Bollywood movie. I don't know whether you have watched. You do watch Bollywood movies, right? One popular Bollywood movies with the title Three Idiots. Ever got a chance to see that movie? Now, in that movie, there was one famous theme marked as all is well. Do you remember, if you have seen this movie? The main character in the movie, who used to just keep mentioning all is well. His friends one day asked him, just by saying all is well, will the problem get solved? He replied that by saying and by believing all is well, problem won't get solved, but you will get enough tolerance to handle that problem. Sensitivity analysis is actually all about that. You get enough tolerance to meet that problem, to encounter that problem, to face that problem and to solve that problem. You will get courage to solve the problem. So what happens? Suppose you are dealing with a project, a capital investment, a long-term investment decision, capital budgeting decision basically. And there is a situation that you have to invest say rupees 10 lakhs today. Life of the project is 5 years. Now you are computing NPV. What all inputs do you require for computing NPV? You require life of the project, 5 years. You require annual cash flow information. Suppose annual cash flow is 3 lakhs every year. You require the prevailing discounting rate. The discounting rate is suppose 10% per annum. And you require another information, that is the cost of the project. I have just conveyed that cost of the project is, where's my other calculator? Oh, I have missed, maybe, let it be. I can manage with this one. The other calculator has GT, so I prefer using that calculator. This one is without GT. I'll have to do a little longer calculation. I'm sorry that I got carried away with my calculator. Let me come back to the concept. So I was giving you an example. Imagine that we are trying to make a fresh investment in a project where the initial outlay, where the initial investment is suppose 10 lakhs. That is the cost of the project. Then we have the cash inflow information available, that every year this project will generate cash inflow of 3 lakhs every year, rupees 3 lakhs. Then the life of this project will be 5 years, and the discounting rate that is applicable in this scenario is 10% per annum. If I give you this much information, what you can do with this information, you can easily compute NPV of the project. I'll show you how to do that. Discounting rate is 10% per annum, life of the project is 5 years, and you can find that annuity is applicable over here because every year you are getting constant cash flow of 3 lakhs. So what I'll do is I will make annuity calculation, and I'm sure you also know how to do it. So I'm going to compute annuity factor for 5 years with discounting rate of 10% per annum. When I do that, I get 3.790787. If you are listening to me with complete attention, like me, along with me, you would have also picked your calculator and you would have actually computed. Otherwise, some people are busy watching just what I am doing, but choice is yours. But you get 3.790787 as the annuity factor on your calculator. You know what we do with this annuity factor? With this annuity factor, we multiply the annual cash flow. So annual cash flows were 3 lakhs every year. This is giving me a lump sum present value of all the future cash inflow as 11,37,236. 11,37,236. That is the total PV of inflow, and the PV of outflow is 10 lakhs. Subtracting, I get a positive NPV of 1,37,236. A positive NPV. The moment you get a positive NPV, believe me, you will have a smile on your face. That project is going to be profitable. That's the idea you get, right? That means you are going to earn more than what you expect. A positive NPV, a positive signal, a green signal to move ahead with the project. Before you are about to take this decision, people around you come close to you and ask you questions that, my dear, you are going to make investment in this project, but there are risks. You are assuming that cash inflows every year will be 3 lakhs, What is the guarantee that every year you will get 3 lakhs of cash inflow? There's no guarantee, right? There's no guarantee. Future is filled with uncertainty. Because of that uncertainty, risk will come. And therefore, if you keep having that fear in your mind and heart, you will never be able to do any business, you will never be able to initiate any project. The day when you join CA, CMA courses, that day people would have again tried to threaten you that, you know, my dear, the pass percentage in this kind of competitive exams, in this kind of professional exams, it is very low. Don't try to do all these courses. There is no guarantee that you will pass. Arey boss, there is no guarantee whether tomorrow I am going to see this world or not. But that doesn't mean that I stop living, right? So all is well. So you have to keep telling yourself that all is well. And sensitivity analysis is all about that. So I was talking about these people coming and telling you that there is no guarantee that there will be cash flow of 3 lakhs every year. What if the cash flows are not 3 lakhs but less? They will always put forward a question as a situation beginning with what if. They will ask you, what if the annual cash flow is not 3 lakhs, it is reduced because of some pandemic situation, because of lockdowns, there will be lesser cash flows. Then how will you manage? You know one thing, that if annual cash flows decline, your NPV will adversely get affected. Then another person will come and say that, see, you are assuming that the life of the project is 5 years. What if there is a technological change in the market and this current project becomes obsolete after 3 years and a new technology comes which overpowers or which overrides this particular technology in which you are trying to work? In that case, how will you manage? Life of the project may not be 5 years. So what if the life of the project is reduced to just 3 years? How will you manage? Somebody would come and say that today you are expecting a rate of return of 10%. You are having cost of capital of 10%. What if the expected rate of return changes in the market, and if it increases, you may have trouble? Now, expected rate of return, if it increases, why we can have trouble? We will have trouble because you should know expected rate of return becomes the discounting rate, correct? If expected rate of return becomes the discounting rate and the discounting rate rising up, it will have a negative impact on NPV. If it has a negative impact on NPV, with the discounting rate rising up, NPV will definitely decline because NPV is inversely related to the discounting rate. I am sure you people are trying to understand what I am conveying. So people will come and tell you, what if the annual cash flow reduces? What if the discounting rate increases? What if the life of the project reduces? How will you manage all these situations? Over there, you just have to answer all these what if questions by an answer starting with even if. For example, before putting your money in this project, you have already analyzed that what if cash flows reduce by 10%. So instead of 3 lakhs every year, the cash flows will be 2,70,000 every year. And you see that even after that, the NPV is positive. Let us check in this case. In this case, let us check. Okay. So if the cash flow is 2,70,000 every year, if I multiply this to that same annuity factor, 3.78, no, it was 3.790787. If I am not wrong, the annuity factor is 3.790787 multiplied to 2,70,000, and from this I subtract 10 lakhs. Boss, I still get a positive NPV. Though the positive NPV amount has declined, but it is not indicating a negative NPV. It is still a positive NPV. So if you come and ask me that, sir, you are trying to invest in this project, what if the annual cash flows reduce by 10%? I will say, even if the annual cash flows reduce by 10%, boss, I don't have to worry, all is well, because even if the cash flows reduce by 10%, my project will not give me loss. Even if the cash flows reduce by 10%, still I will have positive NPV. If I have already made this kind of analytical calculations ready with me, somebody trying to threaten me, somebody trying to have a negative feeling throwing to me, and will I be affected? I'll not be affected if I have known the possible risk and what is the degree of tolerance. That means, can I tolerate the risk of decline in cash flow by 10%? The answer is yes, I can tolerate that. See, when you know that you can tolerate some portion of the risk, your tendency, your attitude towards that risk will change. Correct? Your attitude towards that risk will change. Suppose I am providing you training, you are learning, and I give you some type of questions. In exams, is it guarantee that same type of questions examiner will ask? 99% possibility that examiner will ask bachchu questions which we have already covered up, which we have actually done, and we have done more than that, we have done beyond that. But there is no guarantee. There is a possibility that examiner may throw a twisting question, a question where your real concepts could be tested. At that time, it is not a stereotype question that you will have to handle. It will be a unique, different kind of question that first time has come in examination. People who have learnt mechanically will get stuck with that. People who have learned logically the whole subject will not get stuck, will still solve it. So what will happen if to other people, if this kind of threat comes, that what if this kind of question comes in exam? What if this kind of question comes in exam? But if this question is put forward to you, what if this question comes in exam? You will answer. Even if this question comes in exams, we will handle it because we have learned the subject systematically. We have learned the subject logically. We have not learned it mechanically, that if this kind of question comes, answer it this way. If this kind of question comes, answer it this way. We have learned the subject logically, and therefore we are ready to tolerate that kind of risky situations in exam. Are you people getting my point? So sensitivity analysis tells you what kind of risk you can tolerate, to what degree you can tolerate the risk. Now coming back to the core concept, there are 4 variables that are involved in NPV calculation. I have just explained you the cost of the project, the life of the project, the discounting rate, and the estimate of future cash flows. 4 variables are involved, and anything can change. Literally anything can change. If anything changes, your project will be adversely affected. The NPV may decline. So we have to focus only on the parameters of risk. We don't have to worry about what if annual cash flows increase. Boss, if I have made estimate of annual cash flow as 3 lakhs every year, will you come and ask me, sir, what if the annual cash flows increase? Oh my God, I am so happy. I'll be happier. It will not give a risk to me. Risk will arise only when the cash flows decline. Risk will arise only when the life of the project gets reduced. Risk will arise only when the initial investment in the project increases. Risk will arise only when the discounting rate increases. Anything which has tendency to pull down the NPV to the lower side, that is going to create risk. We will do one thing. We will evaluate what if cash flows reduce by 10%. What if life of the project reduces by 10%? What if the cost of the project increases by 10%? What if discounting rate increases by 10%? 10% I am just giving as an example. You can take any parameter by value and assess to what degree you can tolerate. Suppose if cash flows reduce by 10%, you still get a positive NPV. If cash flows reduce by 15%, will you still get a positive NPV? No, you may not get a positive NPV. So you understand that, boss, I can tolerate the decline in annual cash flows to the extent of 10%, maximum 11%, not beyond that. Correct? That means you know what kind of risk you are taking. So basically, sensitivity analysis makes you prepared that what kind of risk you are taking. You should know it before you jump. So before taking the leap, if you already know what kind of risks are involved, you will never hesitate. The point is, you will never hesitate. See, it is all about somebody's confidence, right? Somebody's confidence can be shattered by giving threats. But if you have made proper sensitivity analysis about your investment decision, your confidence will never be shattered because you know what kind of risk you can tolerate. So what I'll do is, I'll give you some notes on this sensitivity analysis. We will take some initial examples on this and then we will go full-fledged with solving questions. But let me tell you, there can be two different types of questions that can be asked with respect to sensitivity analysis. One where the specific parameters are mentioned, and one where the situation is open situation. Let me explain this. Suppose I give you a parameter of 10%, that what if cash flows reduced by 10%, what if cost of the project increased by 10%. In that case, you just have to keep revising the NPV calculation with that changed parameter. So you compute your original NPV, then you recompute NPV by taking some changed value. For example, as I told you some time back, instead of taking cash flow as 3 lakhs every year, you take cash flow as 2,70,000 every year and recompute NPV. It is all about recomputing NPV. But you may have a different kind of situation, a situation where no parameters are given. They simply ask you analyze the sensitivity of the project. That time the question will be handled little differently, and that is what we are going to learn ahead. So let us do one thing. Whatever we have discussed, let us first write notes on that. Let us take a few examples on that, and then we proceed to the next type of situation. So enough of talking over here. Let me now take you to the notes writing part, and please begin writing the notes now. So under the heading sensitivity analysis, you please write, for determining the net present value, the following 4 variables are required: initial cost, annual cash flows, life of the project or asset, and fourth one is the discounting rate. Any change in any of the variable will result into changes in the amount of net present value. Sensitivity analysis refers to analyzing sensitivity of each of the above 4 variables with respect to NPV. Let us move ahead and take up a very important example. I want you all to first note down all these information. Once you write up all these information, we'll start solving this question. Cost of the project 15 lakhs, life of the project 10 years, annual cash inflow rupees 3 lakhs per annum, discounting rate 10% per annum. Determine the NPV of the project. Now if this is the question, even a kid can solve this question without making mistakes. But this is not the end of the question. What is given further is analyze the sensitivity of each variable considering 10% change. That is number 1, increase in cost of the project by 10%, decrease in the annual cash inflows by 10%. Number 3, increase in discounting rate by 10%, that is from 10% to 11%. Decrease in life of the project by 10%, that is from 10 to 9 years. And also analyze to which factor among the above 4 the project is most sensitive. So look at one thing. First of all, the question is asking you to determine the NPV of the project, which you can definitely determine on your own. Thereafter, it is asking you to analyze the sensitivity of each variable considering a 10% change. Do you know what is the meaning of this line? This line means you try to increase the cost of the project by 10%. So what is the cost of the project? 15 lakhs. You increase the cost of the project by 10%. 10% added to 15 lakhs, that will be 15 lakhs plus 1,50,000. That will give you 16,50,000. Other things remaining same. I repeat, other things remaining same. What will be the impact on NPV if the cost of the project is increasing by 10%? That will be the answer for first part. Answer for second part. If you have to answer the second part, change the amount of annual cash flow from 3 lakhs to 10% less than 3 lakhs. So if you reduce 10% from 3 lakhs, you get 3 lakhs minus 10%. That will be 3 lakh minus 30,000. That is 2,70,000. So recompute NPV using 2,70,000 as annual cash flow. Other things remaining same. Then try making the calculation by increasing the discounting rate by 10%. So discounting rate originally given is 10%. Increase in discounting rate by 10% should not be interpreted as 10 plus 10, 20. it is basically 10% of 10%, means 10% rate, which is the base rate. This rate will increase by 10%, means it will increase from 10% to 11%. So revise the discounting rate to 11% and then again make the calculation. And lastly, you change the life of the project from 10 years to 9 years and recompute NPV. Basically, not once but 5 times you have to compute the NPV, the base NPV with this information, and thereafter, after applying all these 4 changes and then answering this last part as to which factor the project is most sensitive. So how to do this? It is actually very simple. You just try understanding the whole thing. Let us move ahead and we write up the calculation of NPV of the project. Very simple. I don't have to explain you anything. Years, what you take is 1 to 10. Because it is every year same cash flow, we can apply the annuity factor at 10% for 10 years. Annuity factor at 10% per annum for 10 years is 6.144567, and that multiplied to 3 lakhs of annual cash flow, you get the total PV of cash flow. From that you subtract the total PV of outflow, you get NPV, that is the net present value. Thereafter you have to analyze the sensitivity of each variable with 10% change. So what is to be done now? You have to analyze the sensitivity of each variable with 10% change. So question is specifically mentioned in the first part, what will happen if the cost of this project increases by 10%. So from 15 lakhs, if you increase it by 10%, this will become 16,50,000. If this increases by 1,50,000, obviously the NPV will reduce, correct? That is the first implication from the first change informed to you. So let us see how to write up that part of the answer. Cost of the project. The question is, what if the cost of project increases by 10%? So revised cost of project will be 15 lakhs plus 10%, that will be 16,50,000. Revised NPV will be 18,43,370 minus 16,50,000. That is to say that your PV of inflow remains same. What has changed is the PV of outflow, and now the resulting NPV with this change is 1,93,370. Compared to the original NPV, this NPV reduces by 1,50,000. So if you want to find the percentage reduction in NPV, you take 1,50,000 divided by 3,43,370. This was the original NPV that you got, and this is the amount by which NPV got reduced. So the percentage reduction in NPV comes to 43.68%. Conclusion for part 1 will be, if cost of the project increases by 10%, other things remaining same, NPV reduces by 43.68%. Let us move ahead and deal with the next part. The second part of the question says about annual cash flows. What if the annual cash flows are reduced by 10%? Revised annual cash flows will be 2,70,000. Now here we'll have to recompute everything by making one change, just one change. Annual cash flows will become 2,70,000 instead of 3 lakhs. Other things will not change. So PV factor will be continued to be based on 10%. Life of the project will remain 10 years. And this time, don't forget that your total PV of outflow will remain same as original. That will be 15 lakhs. Don't by mistake write here 16,50,000. So net present value comes to 1,59,033. NPV reduces by 184,337, and the revised NPV, once you calculate, you can also show by what value and by what percentage the NPV has got reduced. So NPV has got reduced by 53.68%. Conclusion for part 2 will be, if annual cash inflows reduce by 10%, other things remaining same, NPV reduces by 53.68%. Let us move ahead with the next part, that will be changes in the discounting rate. So third part of the heading will be change in the discounting rate. What if discounting rate increases by 10%, that is increases from 10% to 11%, that means other things remaining same. So we make that relevant change over here. Discounting rate becomes 11% and therefore the annuity factor over here will undergo a change. And you know one thing, when the discounting rate increases, the present value will decline. That means definitely we can expect some reduction in NPV, and the revised NPV is 2,66,770. NPV reduces by 76,600. So the percentage reduction in NPV comes to 22.31%. Conclusion for part 3 will be, if discounting rate increases from 10% to 11%, other things remaining same, NPV reduces by 22.31%. Let us move ahead and deal with part 4, life of the project. So here the focus is on the life of the project with a 10% change. So what will happen if the life of the project reduces from 10 years to 9 years? You might be wondering that why are we having some places increase and some places decrease? Why there is no consistency over here? Answer to that will be, we are talking only and only about risk, right? We are not having fear what if the life of the project increases. We will have fear when the life of project reduces, correct? We don't have fear of cost of the project reducing, but we have fear of cost of the project increasing. We don't have fear of annual cash flows increasing, but we definitely have fear of annual cash flows reducing. So because we are having risk analysis, we are definitely looking into the negative factors, that is all the factors that can create risk, not the factors which can enhance the profitability. Anyway, if you want to deal with this part, just make one change. In the year column, you don't write years 1 to 10 now, you write years 1 to 9. The cash flow remains same. PV factors will be based on 10%, but the discounting rate still remaining same. Your annuity factor will change because the life of the project has altered from 10 years to 9 years, and therefore the resulting NPV will be 2,27,707 and NPV reduces by 1,15,663. Percentage reduction in NPV would come to 33.68%, and the conclusion for part 4 will be, if project life reduces to 9 years, other things remaining same, NPV reduces by 33.68%. Let us move ahead and write up the final conclusion. It is found that the project is most sensitive to the change in annual cash flows. If annual cash flows reduced by 10%, NPV reduces by 53.68%.